Hey folks, David Frost. Welcome back. Welcome to the new year. Welcome to 2018. What I want to talk about first, before we get started with the market analysis, are the changes that are coming to this service. So based on feedback that I've gotten from my members and a lot of other people that would like to see certain things in this type of service, I'm going to make some changes and they will be forthcoming. They're going to be for everybody's benefit. I'm going to cut out some things that people don't necessarily need, and I'm going to add back some things that people want. Namely, I'm going to focus a lot of my effort in 2018 to putting out very solid and actionable swing trades that traders can take advantage of, and then each and every night, we're going to go over some of those swing trades that are on the move in this particular video. There'll be more changes coming, but that's one of the things that I wanted to let everybody know right out of the gate. So one of the main reasons and one of the main benefits for going over swing trades in this video is so that traders can learn what I'm looking at, why a certain trade was taken, how it's acting, how it's reacting, where it is on the chart, and where the target is, and why a target exists on where we're trying to take this trade to. Whether it's on the short side or the long side, either way, that's my intention, is A, to provide swing trade opportunities, and B, and more importantly, to teach you so that you can do this for yourself into the future, and so that you're able to look at charts the correct way, know where the buy zones are, know where the sell zones are. 2017 was pretty much a straight up year with two minor corrections along the way, and they were very shallow corrections at that. I don't expect the same thing for 2018. I don't necessarily think we're going to have a market collapse. However, I do think it's going to be more of a trader's year. I think it's going to be less of a buy and hold year and more of traders being able to take advantage of larger swings in the market that'll move stocks in both directions. And that's one of the reasons and the main reason why I'm making this change. A, it's based on feedback, and B, I think it's going to be a very different year in terms of a trader's type of market. Let's get into some analysis, and I'll bring you more information as time goes on over the next several days, even couple of weeks before I'm ready to launch the new service. The spider, we're looking at the SPY, which is the proxy for the S&P 500, and we have a new closing high. Now, this is actually still part of what's called the Santa Claus rally. The Santa Claus rally typically comes in between Christmas and even extends a couple of days past New Year. So it's really today and even tomorrow. And if we make new highs again tomorrow, that's going to be the first bullish sign that we have for the year 2018. We're still going to have pullbacks. We're still going to have corrections. But this will be the first indication that we get of a bullish year for 2018 if we can have another positive day tomorrow. It's not the end-all, be-all. It's just the first sign, the first indication. So what we have on the daily chart is pretty standard stuff. So if anybody's been watching me for a while, we know that we've had this up move. And basically what we did was we went sideways for about 9 trading days, culminating into the last trading day of 2017. And on the 10th day, all of a sudden, like magic, we have a big, healthy up day in the market. So the first question is, how high do we go on this move? Let's talk about where the first area of resistance should be, and that's based on what I like to teach as market symmetry. So for this, we'll go down to an hourly chart, and what I like to do is I like to see the symmetrical moves in the market. You don't always find symmetrical moves, but when you do, they generally work out a lot of the time. So we've had an up move from the lows, and this is coming from the final trading day of 2017. Then we've had a sideways move, so this is on the hourly chart. So we basically moved sideways for the most part all day today. We moved up in the morning. We had a nice higher move in the first hour of the day. And then we moved sideways for most of the day, and then we started another move higher. So the question is, where is this move higher going to come into the first real point of resistance? Well, based on my calculation, and this is how I calculate market symmetry, we should have about another 40 cents in the spiders on the upside. That's about another 4 S&P handles, and that basically, it's not that much, but it basically takes us on the S&P cash index to about 2,700. That's a nice big fat round number. Maybe it goes to 2,701 or 2,702, but in and around that number, we should have a level of resistance where the market should find resistance and pull back from that level. Now, how the market pulls back from that level is going to tell us a lot for what's coming over the next several days. If we have a very shallow pullback and we start to go sideways again at that level, that's going to tell us that price wants to move higher. If we have some kind of a more violent move downward from that level, that's going to tell us that that's more of a resistance point and we're likely to see more of a pullback over the coming days. So we'll see what happens over the next 40 cents or so in the spider, about 4 or 5 S&P points in the S&P cash index or the S&P futures contract, which would be the S&P E-mini contract. Now we'll turn our attention over to the IWM. Why do we do this? Well, the IWM is my favorite leading market indicator, whether it's on the up or the downside of the market. So the IWM has a tendency to lead the market, or at least give us an indication that the market is going to follow the IWM on the upside or the downside. So today we did have a nice healthy day, almost up 1% in the IWM, but what you'll notice is the IWM is not at new highs like the spider is. So that gives me a little bit of pause. Certainly, we can make new highs in the IWM, and then I would say that the overall market would have a more bullish tone than I even believe it does today. However, the IWM still has work to do to get to the upside and make new highs. We have to get above 3 important levels in the IWM. They're not that far apart from each other, but 3 important levels. First, we have to close above this red candle high. Then we have to close above the next red candle high, which is pretty much close by. And then we have to close above the all-time high, which is still not that far away. The all-time high is 154.77. We're at 153.90 today. It's really not that far away. However, we do have to, on a daily chart closing basis, get above these levels in order for the IWM to power forward and give some jet fuel to the rest of the market. The IWM was the stronger index today as compared to the spider. So the spider was up just a little more than 0.6%, and the IWM was up a little more than 0.9%. So it was the leading index today. It was leading the market on the upside. So if we should get another strong up day in the IWM, I would suggest that the rest of the markets will follow suit. My second favorite leading indicator is the Dow Jones Transportation Average, the DJT. This is the actual index for the Dow Jones Transports. There's an ETF, IYT, that also follows the transports. This has been an absolute monster on the upside of an index. And this is an indication of what the overall economy is telling us. The transports are giving us an indication that the economy is in good shape and likely getting stronger. Why do I say that? Well, what's inside the transports? The transports have the rail stocks, trucking stocks, shipping stocks. When goods are moving back and forth across the country and around the world for that matter, that's good for the economy. It's telling us that people are buying goods, companies are buying goods, they're moving goods, they're building, there's construction going on, and therefore we need those transportation companies to move goods around the country, and therefore it's a good market proxy or leading indicator of the overall health of the economy. So that's one of the reasons why I like to look at the transports. As you can see, the transports had an enormous day today, up 1.86%, almost up 200 points. That's a monster move. Again, we're extended, and if you were paying attention to the videos towards the end of the year and at any point in time, you know what I like to say, that when the market gets too extended from home base, and home base is the 20-period moving average, we likely have to at least stall out, go sideways, or let home base come up to price, or let price come back toward home base in order to reset itself. Doesn't mean there's anything wrong with the market. It just means that the market is getting overextended beyond what is the norm. And what the norm is the market generally doesn't get too far away from home base. So as you can see, the last several days of 2017, the market went sideways. The transports went sideways, allowing the 20-period moving average, which is the red trend line, a chance to catch up to price. Now all of a sudden we're running away from the 20-period moving average again. So the likely story is that we're not going to go too much farther away from the 20-period moving average in the transports before we have to stall out and let price either come back toward home base or let home base come up to price, and that would mean another sideways move for the transports. So the transports are once again right out of the gate, the first day of the year, getting a little bit extended from home base. Now that's not to say that we can't stay this way for a while. I don't want you to misunderstand. Markets can stay extended from the norm for longer than people think they can. That's both on the upside and the downside. But what I'm saying is, on average, on par, the market's unlikely to stay far extended from the 20-period moving average for a long period of time. That's all I want to point out. Can we have another big up day in the transports tomorrow? Of course we can. It doesn't mean we can't. It just means that at some point in time, it's likely that we're going to have to come back toward home base. We're also going to take a look at the VIX, because I think this is going to be a year in 2018 that we're going to have an opportunity to play the VIX quite a bit. Now, if you look at the VIX and just focus in on the type of moves the VIX has, each and every time we get down in this general area below 10, sometimes we get into the low 9s and sometimes we stop at 10, but in this general area, the VIX generally doesn't stay down there for very long, and we have these, whether they're small violent moves or larger violent moves over a day, 2 or 3 or 4 period of time, we have these big tremendous moves in the VIX on a percentage basis. I think that's going to continue, and what I want to point out right now is the VIX is once again below 10. So each and every time the VIX is below 10, my antennas go up and I begin looking to where I can actually buy the VIX on the long side. So I didn't do anything on the first day of the year. I'm going to let the market shake itself out for a couple of days before I jump into a VIX trade. However, if the VIX does get down into the low 9 area or even breaks 9, I will tell you I will be buying the VIX, and this will be one of the type of swing trades that I will be putting out to members as part of the new service offering. So just as a point of interest, we're going to pay close attention to the VIX, especially when it's below 10. If we can get it closer to the 9 area, I think we'll be rewarded handsomely. We'll talk more in the future about the specific ways that we play the VIX, but in brief, it's the VXX, which is an exchange-traded product that tracks the VIX, not my favorite type of vehicle because it really doesn't track the VIX as it should. You can also buy call options on the VIX itself, and then we also have some of the leveraged exchange-traded products as well. We'll get into more of that later when the time comes. Since we don't have any individual stocks to go over yet, I'm going to swing over and talk about the gold market. And as you can see, the gold market was up nicely today, up about $10. And it's interesting because big moves in the stock market don't necessarily coincide with big moves in the gold market. However, we saw them both up today, and that's not a standard correlation by any means. Those of you that know me and have been listening to me for a while know that I don't like to correlate markets together. However, I do take notice when there are certain correlations that are active, and I keep them in the back of my mind. However, what you will notice on the gold chart today, it was on relatively decent volume, and it was a bigger move, which happened to be from the prior or the last important pivot low right down here. This was day number 14. And again, that's an important day for me. What I'll say about that is, under normal conditions, my expectation would be over the next day or two, we would see the gold market begin to, at minimum, of trade sideways or pull back from where we are now. So I think it's overextended. I think it's probably got a touch more upside, maybe up to the 13.25 area, but I don't see the gold market getting much past 13.25 without one of two things happening: either a pullback or sideways consolidation first, and secondly, without some kind of event, some kind of geopolitical news that could certainly drive the gold market forward. So we'll keep watching, but right here I think it's a little bit overcooked, And this certainly isn't a place to get long the gold market. This is a place to protect any profits if you were or are long the gold market. We'll also look at GDX, which is a basket of gold mining stocks. And you can see pretty clearly here that this pivot top should, under normal conditions, provide resistance to the market. Comes in at about $24. The exact number of this pivot high happens to be $23.99, and I wouldn't expect GDX to get through there like a hot knife through butter. It's not going to just walk through $24 a share. If you're long GDX, I would protect the profits. I would take some profit along the way. If you're not, this is not a place to buy GDX. However, since we are above all the moving averages, if we do get some kind of a pullback or some kind of a bullish consolidation pattern, then I would be looking for an opportunity to get long GDX under the right circumstances, but not here, not now. Crude oil didn't do much today, so there's not much to discuss. As you can see, the uptrend remains intact in crude oil. We're above $60 a barrel. Right here, we are at somewhat of a resistance point for crude oil. However, if crude should get past this area and get through 60 and a half, let's say $60.50 a barrel, then the next major area of resistance is $2 higher at about $62.50, even up to $63 a barrel. So there is some upside in the cards for crude oil if we can bust through this area. So we'll watch it closely over the next couple of days. And that would be positive for various oil and energy related stocks. And just as an example, you can see here with the XLE, what a tremendous move the XLE is making and has made over the last few weeks. The XLE is a basket of oil and energy related stocks. However, we should be at some kind of resistance point for the XLE right here, maybe up to about $74 a share, and I'll show you where I get that from. When you go over to the weekly chart, you can see here the 200-week moving average. We're not going to just walk through that area without some kind of a fight. So that comes in at just short of 74, 73, 75 right now. So the chances are we could pop through it a little bit, maybe up to 75. But for us to close the week above $74 would be extremely bullish for the XLE. So I just wanted to point that out for those of you that follow the XLE and the energy-related sector. And I think for today, that's where I'm going to wrap it here. Each and every night, I'm going to add a little bit of variety to the videos based on what's moving, what's important to the market, and what's driving the market either up or down. So we're going to rotate in and around different sectors of the market, and we'll cover different areas that happen to be on the move and where opportunities exist. So with that, I'm going to give it a wrap here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.